I'm Daniel.
And I'm Mira.
So it is Sunday evening, July 5, 2026, and we are just wrapping up the holiday weekend here.
Yeah, holiday weekend that ended up being incredibly busy on the news front, honestly.
Seriously. But real quick, before we dive into all that, I need to give our standard disclaimer. Everything we discuss in this deep dive is strictly from market context and discussion. It is not personal investment advice or, a recommendation. So always do your own research.
Exactly. Our whole mission today is just to help you understand the macro baseline as you enter this new week.
Right. And there's a lot to map out for you. We've got this weird collision happening right now, a softening labor market running headfirst into sticky inflation, plus a massive reality check on the $700 billion AI CapEx supercycle. Oh, and, just some major geopolitical shifts that are completely rewriting global energy right now.
Just a few minor things, right?
Yeah, right. So let's jump right into session one. How did the market move over the past week?
Well, if you were just glancing at the surface, you'd think it was a totally sleepy week.
Yeah.
Between Monday, June 29 and Thursday, July 2. Keeping in mind, cash markets were closed Friday for the 4th of July. The S&P 500 basically just flatlined. It closed at 7,483.24.
But beneath that flat line, the divergence was just massive. The tech-heavy Nasdaq took a serious hit, dropping down to 25,832.67.
Right, because those big AI winners were selling off hard.
Exactly. But then, at the exact same time, the Dow Jones Industrial Average just kept steadily marching higher, finishing at a record high close near 52,900.07.
Which is fascinating. Usually a semiconductor sell-off like that would trigger a lot of panic.
You would think. But the VIX actually cooled down to 15.81. And we've talked about this before. Sector rotation can mute volatility spikes. The capital was just shifting, not evaporating.
Yeah, and to really understand that rotation, you have to look at the bond market. So the 10-year Treasury note yield ended the week near 4.49%, and futures slid to about 109.55. And the 2-year yield slipped a bit too, landing around 4.13%. We always say discount rates act as valuation gravity, right?
Yep. Higher the rate, the heavier the gravity on those long-duration tech stocks.
Precisely. That gravity is why high-flying tech felt so much pain last week. But what's crucial is that credit spreads stayed remarkably contained. High-yield option-adjusted spreads were hovering around 2.75%.
Oh, wow. Still that tight.
Yeah. And investment-grade spreads were around 0.75%. So clearly, the market isn't panicking about a recession. Corporate debt is fine.
They're just reducing their crowded AI bets.
Got it. And we should touch on commodities and currencies really quick, too. The U.S. dollar index softened a bit, dropping to 100.86.
But gold went crazy.
Oh, totally. Gold surged to a weekly close of $4,187.30. It actually hit a pre-market high on Friday of $4,208.30. Meanwhile, crude oil just contracted sharply.
WTI dropped down to $68.78, right? Yeah, and Brent fell to $72.13. So, to wrap up session one, the market definitely isn't pricing in a broad recession. It's just aggressively rotating out of crowded AI exposure.
Which perfectly sets the stage for the weekend news. Let's take a very quick break, and then we'll get into the catalysts.
Sounds good.
All right, welcome back. Let's move into session two. What were the key weekend news events and their market implications?
And there was a lot.
There really was. And just to set the stage, remember the watch next items we highlighted at the end of the July 3rd session recap? We were looking ahead to PMI data, the trade balance, FOMC minutes, and jobless claims.
Right.
Well, the news that broke this weekend is going to completely color how the market interprets all that incoming data. Start with theme one. Geopolitics and the massive energy supply shift.
Yeah, the timeline on this is wild. So on Saturday, July 4 at 4 p.m. Eastern Time, former President Trump had a 1 hour and 25-minute phone call with Russia's Vladimir Putin.
And he spoke with Ukraine's Zelensky too, right?
Yes, exactly. It was described as a pragmatic call to coordinate peace negotiations right ahead of the upcoming NATO summit. Envoys are actually preparing to visit Moscow as we speak.
And then literally hours later.
Sunday, July 5 at 3:24 a.m. Eastern Time, OPEC Plus suddenly agreed to boost oil output by 188,000 barrels per day starting in August.
Plus, you've got Russia's Urals crude plunging 60% since March. It's under $45 a barrel now.
It's gotten so bad they had to slash their foreign exchange purchases. Oh, and on top of all that, Oman and Qatar are resuming maritime operations because of that fragile 60-day U.S.-Iran-Hormuz ceasefire.
It's a massive string of supply relief.
It is. And, I have to say, the market has this terrible habit of treating geopolitical events like unpredictable natural disasters, like, oh, a storm just hit the supply chain.
Oh, yeah, they panic.
But if you look at it through a game-theoretic lens, geopolitical choke points act as bargaining leverage. This de-escalation in Ukraine and the easing in Hormuz, these aren't just lucky breaks. They're calculated structural shifts ahead of major summits.
Yeah, and the macro implication of that is huge because falling oil prices act as a massive relief valve. We always say energy shocks operate as consumer taxes.
Right.
So when energy prices plunge like this, it's basically a massive tax cut for the consumer.
Yeah.
This is highly risk-on for consumer and industrial sectors.
Absolutely. But that brings us right into theme 2, which kind of complicates that relief valve.
Wow.
We had this collision between the labor market and central bank policy.
Right. The U.S. added a really weak 57,000 jobs in June. And worse, 720,000 people just left the labor force entirely.
That's a staggering drop-off. But at the same time, the May CPI and PCE numbers, they're still sticky. Inflation isn't dying.
And it's a global headache. Over the weekend, ECB officials, Pierre Moulin and Joachim Nagel, they both emphasized that they have to stay vigilant despite the oil drop.
Yeah, the Bank of England reported their business inflation expectations actually ticked up to 4.1%.
And back in the U.S., the political pressure is ramping up. On Thursday, July 2, Trump publicly criticized Fed Chair Kevin Warsh and Governor Lisa Cook.
Which puts the Fed in a brutal spot.
It does. And if we connect this to the bigger picture, it really challenges that Goldilocks soft landing narrative everyone wants to believe in. Celebrating a cooling labor market is incredibly dangerous right now.
Because everyone just assumes bad news for jobs means good news for rate cuts.
Right. But lower rates fail when earnings collapse. A dovish pivot from the Fed won't save equity markets if the consumer's revenue dries up because they don't have jobs.
That's a really important reality check. Speaking of reality checks, theme 3 is the AI CapEx reality check and the physical grid.
The numbers here are just mind-boggling.
They really are. So hyperscalers are planning over $700 billion in AI capital spending for 2026 alone. $700 billion.
But the physical toll is already showing.
Yeah, and we saw it happen live this week. On Thursday, July 2, at 5:21 p.m. Eastern Time, the PJM interconnection grid hit absolute record demand. They had to trigger generational alerts just to prevent a collapse. And the next day, Friday, July 3, Con Edison actually had to cut power to 9,800 customers in Queens because of the heat and demand.
Just completely tapped out.
Exactly. Meanwhile, on the geopolitical side of tech, Anthropic is actively sealing loopholes that were allowing Chinese access to their Claude AI models.
Okay, let's unpack this. We've described AI CapEx as a cycle-agnostic arms race. Companies are spending this money regardless of interest rates because they feel they have to.
Right.
But power access is AI's physical bottleneck. You can't just code your way out of a blown transformer in Queens. Software multiples are compressing right now because the market is suddenly demanding real-world physical returns on this massive infrastructure spend.
Yeah, they want to see how you actually power these things before they give you a higher valuation.
Exactly. So to distill all of this weekend action, we have tumbling energy tail risks providing some relief, but rising physical tech bottlenecks and sticky inflation causing major friction.
Which is a perfect pivot point. Let's take a quick breather and then we'll look at the calendar for the week ahead. Okay, welcome back to session 3. What should we watch in the coming week? We've had all these massive macro shifts over the weekend, but what actual data will confirm or deny them?
Well, looking at our Watch Next list, Monday, July 6 is going to be incredibly telling. At 9:45 a.m. and 10 a.m. Eastern Time, we get the June S&P Global Final Services PMI and the ISM Services PMI.
Okay, so heavy on the services side.
Yeah, and this is really going to test that sticky services inflation narrative.
Yeah.
We need to see if those costs are actually cooling down.
Got it. Then on Tuesday, July 7, at 8:30 a.m. Eastern Time, we get the May U.S. trade balance.
And Wednesday, July 8 at 2 p.m. Eastern Time is going to be massive. We get the FOMC minutes from the June meeting.
Oh, yeah. That will give us so much insight into Kevin Warsh's whole data-dependent reset. We need to see how hawkish they really sounded behind closed doors.
Definitely. Then Thursday, July 9 is a doubleheader. At 8:30 a.m. Eastern Time, we have weekly jobless claims.
Which everyone is going to overanalyze after that weak 57,000 jobs number.
Yeah, absolutely. And then shortly after, at 10 a.m. Eastern Time, we get June existing home sales.
All right, well, as we prep our screens for Monday, we need a bit of a Sunday night reset because, think about it. We're looking at a market where tech stocks are on a diet, the U.S. grid is literally running on fumes, and gold is priced like it's the only asset left standing.
Pretty much.
With only 57,000 jobs added, we're all just praying Kevin Warsh doesn't count our Sunday night prep work as a sign of an overheating labor market.
Yeah, please no.
Meanwhile, corporate boards are staring at $700 billion AI bills, desperately hoping generative agents can learn to build power plants. But hey, at least crude oil cooled off, meaning it's slightly cheaper to fuel up the car you might have to live in if this tech rotation continues.
A dark but fair assessment.
Right. Okay, that wraps up the regular session.